you can now put everything into an AI, EDS, looking at external, internal data sources, and just get answers to the questions. Like in the prior iteration of like a research management system, if you had to find an answer on what is Apple's AI strategy, you'd have to go through all of the different nodes, see if there was a node that was not even for Apple that referenced the AI strategy for Apple. But now you can just use AI and say, all the nodes are indexed, the transcripts are there, we have all the sell-side data, you have all of the expert network calls that you've done, everything there to help you make a decision or find an answer. So I think AI is sort of a game changer with that. And, our journey with AI is let's index all the nodes.
Hey, and welcome to the Momentum Podcast, the show where FinTech meets AI. I'm your host, Stan Altshuller, investor, founder, and advisor to some of the world's top hedge funds, asset managers, and data companies. Each week, we'll dive into practical AI strategies to help you cut through the noise, beat data overload, build smarter workflows, and turn your ideas into results. We'll explore everything from AI tools for your daily workflows to building data-driven growth engines for your organizations. Here, you'll discover what's next in finance and how to stay ahead of the curve with AI. Let's dive in. All right. Hello and welcome to the Momentum Podcast. With me today, I have Ben and Sandeep from Equity Data Science. We're going to talk to them about all the things that they do in the hedge fund industry. They have excellent technology when it comes to portfolio management and risk management, and they service hedge fund managers, which is an area I'm very familiar with. And why don't we start off with Sandeep maybe, and then you, Ben. Just give us a very brief background, and then we're going to hop right into the questions.
Yeah, great. Stan, thanks so much for having us. So I'll give you a quick background about me, and then, how we started the company, where I met Ben as well. So I completed my engineering degree from Cornell back in 2004. I worked on Wall Street in various roles. My last role was actually at Credit Suisse as a technologist to quant analyst, and I actually worked with Ben over there. My job was to help aggregate hedge fund positions and help create like a report which would tell hedge fund managers about aggregate positioning, say across sectors, gross and net exposures, crowding data. So a lot of quantitative analytical data about what was happening with the industry. I was really interested in investing myself. I started studying for the CFA charter. I got my CFA charter in 2010 or 2011. And then I was approached by a guy called Steve Galbraith. Steve Galbraith was the ex-chief investment officer at Morgan Stanley. He co-ran Maverick Capital with D. Ainsley, who was seated by Julian Robertson back in the day.
Sure.
And, he liked the skill set that I had. He liked the fact that I was so passionate about investing, even though I didn't really have an investing background. I told him that, I'd really want to apply what I learned in the CFA charter in technology, or using technology. I want to sort of make it come to life. And he actually shared a framework with me. The framework, I still have that to this day. It's called the quantitative framework, or that Word document was titled the quantitative framework for a fundamental portfolio manager. It outlined how Steve wanted to do idea generation, portfolio construction, as well as risk management. And for me, it was really exciting because it was like everything that I learned when I was studying for the CFA charter, as I am going to get to apply it in practice, and I had the technical skills. And instead of, building it in Excel, which was the norm for the day back then in 2012, I utilized a visualization front end. I used Tableau at that time.
Yep.
I put cloud backend on top of it. And for me, it was very simple, but the effect on the PM and on fundraising was tremendous.
Right.
Because back in that day, they were like, oh, for a small fund, you guys have this amazing infrastructure.
Yeah.
And then the other analysts at the firm started using it too.
Yeah.
And that was very exciting for me because, you create the software, everyone's using it.
And there's the multiplier effect across the whole organization. You're benefiting everybody.
Exactly.
That's good.
Exactly. And then, for me, I was like, okay, I built a platform, spending 2 or 3 days a week enhancing the platform, but I have time, right? So I told Steve, I was like, hey, you know what? Maybe let me fundamentally use the tools. I basically told Steve, let me become a fundamental analyst, or let me try and fundamentally analyze some companies. I use the data that, the team was using for idea generation, came up with some ideas that I would do fundamental work on, figured out, using the data, how to size the position, look at catalysts, etc.
Yep.
And I was pretty decent at it because, you're just basically applying a disciplined process.
Yes. Yes.
So with that discipline, I started getting better at it as a fundamental investor. And then I came across Greg, and Greg and I were both researching technology companies to invest in. And we just started talking and over lunches and dinners. And we basically thought that there's commercial applicability there. And then when Steve converted to a family office, I went and worked for another Tiger Cub, Roberto Mignoni. And Bridger.
Oh, that's a Bridger. Sure, that's another Tiger Cub.
Bridger.
Oh, yes.
Another
That's great.
Yes. And, what I noticed with Bridger was a very different strategy than Steve's. So Steve was more value contrarian. Bridger was more growth, momentum oriented a little bit as well.
Sure.
I was like, what, there needs to be like a software and data engineering layer to make this platform scalable for all different kinds of managers.
And there's so many different styles, right? You go from one manager to the next, and the way they look at the world is quite different, which is great because that's what makes them unique, and that's how they look at the world differently. So they have their own particular way of identifying value, monetizing that value. Everybody has a different style, but for a toolsmith, it makes for a very particular challenge because now you have to consider all the different ways that you could be looking at the world and almost account for. You're not going to account for 100%, but as many as possible. And I have seen that firsthand. And I know it ain't simple. It is definitely a product problem. It is a user experience or user interface problem. It is definitely sophisticated and a challenging approach. And I would love to dig into it more on how you solve it. But maybe we to take just a step back, and if you could, and Ben, feel free to jump in here. But if you could summarize to me, and knowing full well that equity data science solves a lot of different problems for a lot of different types of investors. But if you could summarize kind of the problem that you identified, that maybe you had that aha moment, whether it be at Bridger or Credit Suisse or somewhere in between, where you said, this is a big enough problem for me to drop everything, to veer off my course and to start something new. What is that problem? How did you measure the size of it, and how did you come to the epiphany that it is worthwhile to actually pursue it with your own endeavor?
Perfect, right? So the research process is very disaggregated at these fundamental firms. So, they're not technologists. They know how to analyze companies, go through 10Qs, 10Ks, but increasingly you have to use a lot of data to make an investment. Like, so for example, at Bridger, we would get into hard to borrow shorts, but you needed the short data and you needed to know, okay, what was happening with the short interest, with the borrow rates to be able to actually take on that position. So you had to basically have some sort of feed, which would take into account, our price targets, our risk rewards, along with the street short interest, along with, say, the borrow rate data from some other data source, along with some credit card data that we had access to. And for that, you had to create some sort of standard nomenclature to connect all these data sources and bring them into a platform. The platform of choice for most of these funds was Excel.
I mean, it still is for many.
It is for many.
Big Excel models out there. Yep.
Yes, exactly. So the research process was just so disparate.
Yes.
And there was no way to sort of aggregate that data. And then once you brought all the data together in Excel, there's the auditability, the historical, creating the records, and then maybe having some sort of feedback loop to see, okay, this process actually work in terms of giving me a good idea or in terms of like sizing, etc. None of that was there. So there was no database behind it. So
no, I mean, Excel was just not built. Excel was just not built to do that. And that's a big opportunity for a different solution. Yeah,
exactly. So the research process was disaggregated. Now the research process, you can break it down into various different parts, like idea generation is one, the ways of size positions, that could be part of it as well. And then, you just basically have a workflow where you're assigning names to certain analysts, figuring out what stage, what are people working on. So all of that is part of the research management process, right?
Absolutely.
And then the other piece was, okay, once you've aggregated the research, you've gotten some insights from it, how do you sort of measure or create a portfolio, an optimal portfolio, and then measure the risk of the portfolio.
Right.
And then when you're creating the right portfolio, how do you create the most optimal portfolio? So those are the things that we solve. So at a high level, we solve like the risk and research workflows.
Excellent. And Ben, do you want to jump in and maybe talk a little bit about the pain of that data? Ben is on the data science end, as I understood it from the prior conversation we briefly had right before the podcast. But can you talk to us, give us that perspective of like, what is the pain points that people are feeling? Sandeep touched on it. They've got a lot of different data. They want to do things like attribution and measure risk and talk to investors as if they're institutionalized process, but they're really fundamental investors. They're very, very good at that. That is their skill set, not necessarily everything else. Can you put some color around the particular pain point of data and what is the journey that people go through? And maybe you can loop that in. How do you think about helping them and how do you start to help them get to a place where they are able to answer these questions and they are able to build a robust, platform?
So I'm Ben Lieblich. I'm Chief Data Scientist at EDS. As Sandeep mentioned, we used to work together at Credit Suisse, and him and Greg brought me on kind of early on in the journey. One of the jobs I had early on in my career, I worked at a hedge fund for a little while, and we didn't really have, it was a startup fund. We didn't really have risk tools. I was kind of coming in to try to help with risk. We weren't using any factor models, and the fund was very volatile. It ended up, I wasn't there for this full period, but it ended up shutting down after 3 years. And they just didn't really have a good handle. They're stock pickers,
Right.
And they didn't have a good handle on the portfolio. He had come from a large fund and he had done well there, but wasn't really able to replicate stable returns on his own. When the industry has evolved over the 9 years that EDS has been around, and at first, that was one of the early things. Like, we made relationships with MSCI to bring their factor models into EDS because we started it. We had a couple of clients that were pulling them in, but we weren't really using them very well. It was not very popular to use factor models back then for fundamental hedge funds. They really didn't care that much about them. They were much more focused on just picking the stock factors. That's not what moves stocks. The industry has changed wildly in the last 10 years in that respect. And so we were kind of very early in that. That was something we saw that was a big issue, something that I had experienced in the past that was an issue. And so we were able to bring that into the system and kind of built our risk management layer kind of around that. And that has been a very big performer. It's been a big tailwind for us as investors, asset owners, and thus the funds themselves started to care a lot more about the actual risk.
Well, begrudgingly so, right? I mean, I've noticed this shift myself personally. Fundamental managers, they love the story stocks. They love doing the research. This is how they got good at it because they're so passionate about it. Risk is an afterthought. But as LPs started to actually demand it, hey, we need to understand what goes on in the sort of market regime where everything is correlated. We need to understand what happens if you've got exposure to, let's say, China on a look-through basis and all that stuff. And the PM's eyes glaze over and oh, well, that's data. And oh, well, that's, factor exposure and that's risk. And now they're like, no, you have to have an understanding. You have to be at least factor aware, right?
That really evolved a lot, honestly. Even the factor awareness concept, that's how it began because of the LPs. But now it's not really like that. It's the fund themselves. They want to to have a better handle on their portfolio. I mean, the market is so volatile. Just think of the last week has been wild, and it's not idiot. It's not, someone's not picking a stock and it's dropping 15% because of that stock. And so people just feel gradually it has moved from okay, we don't care about this, to okay, we have to do this, to okay, we have to do this because of our LPs. Now, okay, no, we really need to do this. And it really helps us understand what's going on with our portfolio.
Well, that's fantastic. And how is that trend? Are they getting better at it? From your seat, maybe Sandeep or Ben, our PMs. There was a time where PMs were really into data science and they were taking, courses at night and weekends, trying to get some scripts done in Python. Is that, and then it kind of died down. How is that now? Are people, actually data savvy, statistics savvy? Do they understand risk? Is that evolved, or do they kind of just EDS just handle it and Ben and Sandeep just handle it all for me? I don't want to know. Just give me a pretty dashboard.
It's interesting. I would say when you think back, there have been a lot of different like trends that have gone on over the last 9 years, which is how long we've been building EDS. Like there was the alt data craze, and everyone's like, okay, we need a data science this, and that just kind of like disappeared basically because people were like, okay, they only really figured out how to use this kind of predict quarters, and then the data became commoditized. And but in terms of and data science, you should all learn how to code. Obviously, no one's trying to code now. Like, the AI is doing all your coding.
Right.
And even like the data science, like it's not, that is something that sort of people tried to maybe start doing. It is, I never see anything like that. People are doing what they should do, in my opinion, which is they are learning what they need to know. They don't need to know how to do the math. They just need to know how to interpret the results.
Right.
And that is really kind of where we see it move. And, with the pod shops are all growing too, Citadel, Millenniums, those have been getting more and more assets. And they have a lot of these tools. And so a lot of the successful managers that are even coming out of there and having startups, they have the kind of pedigree of using this type of information and knowing how to manage their book because they were required to over there. So it's really kind of evolved in that way. And I don't really see managers that being an important skill set. Like the whole point of a lot of this, of us existing in the first place, is that the managers, the PMs, the analysts should really be focused on their core competency, which is picking stocks that have positive specific return or idiosyncratic return. And let the quant or let us or do the kind of a portfolio construction, risk management for you. So you focus on what you're good at and let other people focus on what they're good at.
That's great.
Yeah, Stan, and from my perspective, I'll tell you a slightly different take, but sort of very consistent. When I was getting started with Steve, I'd spoken to a number of my friends who were PMs or analysts, and they said the way a startup hedge fund was formed back in those days was you would have a bunch of fundamental analysts, one PM and one quant. Right. And I was that quant.
Correct.
But then that quant had to do everything, which is aggregate all the data, but also start looking at the alternative data. So what our pitch is that, look, there is a software and data engineering piece to your analysis or your job as a quant, or even as a risk manager, right? You don't want to be focused on that. You want to be focused more on interpreting those results.
Yes.
For the PM as a risk manager. Or if you're a quant there, you want to be focused on, alpha generation, maybe, finding some trends with the all data so that you're helping the analyst make money essentially and leave all of the data engineering, software engineering to firms like us.
Absolutely. You touched on something, Ben. You touched on AI just a little bit, and I want to maybe dig a little bit deeper into that, but within context. And the context I want to, get your thoughts on is the way that the industry is evolving. And I think you've mentioned this, like especially that flows are really concentrated and they're going to these super big pod shops, these multi-manager shops, these big quants and relative value shops, massive shops. Does AI and the technology that you guys are working on, does that give the long short equity manager that's maybe just starting out or maybe still managing under $1 billion, and maybe they've been stuck at $1 billion for a long time and, it's hard for them to grow. Does this sort of technology disruption give them an opportunity to break out and grow or at least become institutionalized in the eyes of these LPs where they can say, yeah, I don't really need a lot more of Bridgewater or Millennium or whatever. I can go ahead and, these guys seem to be really good stock pickers, but they also check these boxes. Do you see that happening? How is technology helping them actually win those allocations and grow?
We often actually get a lot of the startup funds. Like, in fact, right before this call, I was on with the 0.72 spin. We'll have like Citadel spins. When those guys basically are at these pawn shops, they generally have to adhere to a much higher EDO. So one of the Citadel PMs we have on our platform, he was frustrated when he was at Citadel because he had to adhere to a 90% EDO. And really your alpha is being, I wouldn't say it's been taken away because, obviously you're making sure that most of your EDO risk is coming from alpha. But he didn't really want to adhere to that 90% limit. So when he started his own firm, he's like, okay, my investment mandate is 70% EDO. Now, just in terms of where AI can be used to level the playing field, these analysts when you're at a pod shop at say a Citadel, you're having a lot of junior analysts just do a lot of research. But when you're doing the research, you have to consume the research, right? There's research that's quantitative, and then there's research that's qualitative. You're speaking to industry experts. You're obviously aggregating all the sell side reports, earnings transcripts, and all the internal data, right? You can now put everything into an AI, EDS, looking at external, internal data sources, and just get answers to the questions. Like in the prior iteration of like a research management system, if you had to find an answer on what is Apple's AI strategy, you'd have to go through all of the different nodes, see if there was a node that was not even for Apple that referenced the AI strategy for Apple. But now you can just use AI and say, all the nodes are indexed, the transcripts are there, we have all the sell side data, you have all of the expert network calls that you've done, everything there to help you make a decision or find an answer. So I think AI is sort of a game changer with that. And, our journey with AI is let's index all the nodes and the external data sets, but then also combine that with the position data as well as the quantitative, say, upside, downside estimates that we uniquely have. So we uniquely have the client's internal quantitative plus qualitative data.
Yeah. No, that's great. And, and a lot of folks that work at banks and at hedge funds, they have, there are specific policies not to use like a ChatGPT or an Anthropic or Claude. People still do it, right? And that I think that's a big risk to companies because there's an urge there. You want to be more productive than the next guy sitting next to you, or just for the benefit of the company. And so there's this urge of copy and pasting your data into the cloud, and who knows, like maybe they're training models on it, maybe not, who knows, right? Or what goes on with your data. How do you think about that within your systems? How do hedge funds gain comfort in using your AI with all the compliance burden and all these, they're regulated most of the time. How do you help them gain comfort around that?
I kind of see this as very akin to the rise of the cloud. When EDS was beginning, everything was on-prem and we were cloud. And we had a lot of people who were like, oh, can you do an on-prem version for us? And we're like, yeah, if you pay us a lot more,
Yes.
No one doesn't use the cloud.
Right.
It's the same thing here. They were concerned. They didn't want to be the first, especially in the hedge fund world, compliance, hedge fund finance world. They're not going to be the first movers. But as it gains popularity and people gain confidence in the solutions, then people are going to go there. There is no way that even in the next couple of years, I think it makes no sense for people not to use ChatGPT and Claude, try to build their own homegrown solution that's not going to be as good. They're going to be losing to people that are not using it. And Claude does not care about some hedge fund's position. They're very
absolutely true.
I think that people who think that are really overestimating the importance of their information. It's transient. Like you made your there right now, Anthropic is raising a $400 billion round. All right. OpenAI raised $700 billion round. They don't care about some hedge fund's position. It doesn't do anything for them. And in addition to that, in all of their terms and conditions, like they don't use the API prompts for training. And so I think the forward-looking funds recognize this, and they're not going to let themselves get held back because of that. We do, of course, have all these with clients. We have like documents that say, it's dependent on OpenAI or Anthropic's terms and conditions. If they lie, then yes, it could be exposed theoretically to their training. But I don't really see this is going to be an issue in the next couple of years. People are going to accept the technology.
That is really interesting. Yeah,
but it is a question you keep fielding from asset managers all the time.
Right. I think that's cloud analogy is a very apt one because there was a lot of uncertainty, right, with the cloud and a lot of just questions that weren't answered. And then people realized that the risk is just much, much smaller than the value you're going to get. I think the same thing is going to happen with AI, and traders are very good at weighing these risks, and they're just going to make the trade. And so if we transition, if you allow me to transition a little bit into the hypothetical, right? So the way AI is progressing and the way these models are coming out, the speed at which they're just getting better and smarter, do we even need software and risk and all that? Can we just have, maybe not today, but in a couple of months, year, can we just have the AI just manage all the risk and do it in the trade? Do we even need this? Isn't it just better than humans because it can get more data and more risk aware of all the factors and everything?
I do think increasingly it's a productivity tool, right? Obviously, I think the amplification is multiples of what a regular technology curve would do. But I do think, ultimately as a PM or an analyst, you get paid for making those decisions. So, you can use all these tools to make those decisions. But at the end of the day, if things don't turn or go your way, you still have to defend those. You can't just say the AI.
You can't just say, hey, ChatGPT told me to buy it, right?
Yeah. Exactly. So, what we want to do, what we want to be in the business of is just indexing all of that data, like using MCP servers or using our own chatbot, use a combination of Claude or ChatGPT, or if people are comfortable using ChatGPT or Claude, make our data or their data available such that they can leverage that data when they, build their algos or try to find answers to questions. I do think it's always going to be an AI plus, I call it human intelligence, which is going to sort of win the day. But we'll see how this evolves, It definitely makes sense from a portfolio construction perspective, which is where quants traditionally helped PMs. It makes sense to have some sort of AI quant or some sort of data process take over that process or help you optimize it. I don't know if fundamental equity managers will give up full control. But there's obviously going to be like a full spectrum of products out there, from obviously the pure indexing to sort of the active indexing through AI to fully actively managed.
Yeah.
Asset managers and hedge funds.
That makes a lot of sense. And look, you guys deal with a lot of data. So if I am a resource constrained fund, right? We're not talking about billions and billions of dollars. Maybe I run 500, 750. There's all this data out there. There's credit card data. There's web receipt. There's, emails, web scraping, all sorts of data that you can imagine, geolocation and so on. There's also risk data. There's internal data. It's hard to focus on everything. Obviously, you want to get as much input into your investment process as possible. In your experience, how do they start? What is the most important piece of data to really get your head around and to start really utilizing and leveraging for a hedge fund manager?
I guess it depends from a hedge fund manager if you're more fundamental in nature, where you care about, say, EDO. Like, some of the Citadel spins, 0.72 spins, they will have a certain EDO threshold as part of the investment mandate, right? A Citadel spin might go to their investors and say, we're going to have at least a 70% EDO and we're going to adhere to that throughout. But then there'll be other asset managers, they'll be like, we're going to be more factor aware. So those factor aware guys will probably start with leveraging their internal research, expected returns, risk reward ratios. They'll start piping their estimates into the platform. And then they'll use that to do fundamental research and to, speed up their fundamental research, right? So that can be done in a research system. As the other end of the spectrum is the more quantamental funds, more risk factor aware, they will essentially use the data and they'll start with, say, a factor model that they have access to, and then they'll start putting in more of their research data. And then increasingly you're seeing clients start with both the risk and research platform. Because, while they want to have like a systematic research process where all their notes and price targets and estimates are all in one platform, they also want to know that the portfolios that they construct are adhering to certain risk limits and thresholds.
And let's do a question just for you guys as we're up here. What is kind of like that elevator pitch? If you had a big speakerphone and you could reach every single hedge fund portfolio manager in the world, what would be the pitch? Like, what would you tell them to do? Like you've mentioned, hey, have control of all your data in one place. Give me that one value proposition that's totally killer, that as soon as people hear it, they're going to want to reach out to you and get a call with you or with Ben or with Greg.
Yeah. I don't know if I have that killer pitch, but, if your best one, every hedge fund, when they make decisions, they're basically making decisions from their research. And then they also need to monitor their risk. So if you want to have a system that leverages all of your internal data, the mosaic that you have in your head, and you think of it along the lines of, say, risk and the research that you use to come up with your decision, we have the tools to help you, get up to speed very quickly.
And what's the best way they can reach out to you?
Just reach out to us through the website, equitydatascience.com, or just sales@equitydatascience.
That's perfect. Well, thank you guys so much for being guests here on the Momentum Podcast. Really, really, truly, deeply enjoyed the conversation. And I hope you get a lot of calls from our viewers here. I personally know you guys and love you guys. You're doing an incredible job. We've been good friends since my Nova's days, and we've kept in touch. I'm very, very thankful for that relationship. Sandeep, thank you, Ben. It's a great pleasure to meet you, and so happy you were able to join us here today as well. Thank you, guys. And
thanks so much, Tanner. It was great to be here. Really appreciate having us.
Take care. Thanks for tuning into Momentum. If you found today's episode valuable, don't forget to follow the show and share it with your network. This helps us a lot. To explore how AI can help your firm, visit acadia.im. I'm Stan Altshuller, and I'll see you next week with more practical insights to help turn data into growth and decisions into results with the help of AI.